Today's video is sponsored by Moomoo. More on them in a moment. Check the link down below in the meantime. Hey everyone, me Kevin here. So it's usually on days like today that I post a video like a warning to investors, but because the market is green, most people think that I'm just trying to FUD stocks to make them go lower because I have shorts and, well, I want to make tendies off the shorts, and because I'm a shill and bought by the hedgies, well, then naturally I'm losing money when the market's going up. And the market is going up. Indices are up. Lots of stocks are up. Toast is up. Bitcoin's up. Tesla's up. Pretty much everything's up. Well, I hate to burst those haters' bubble, but I have no short positions. I'm not bought by the hedgies, and I'm not wearing a suit either. Folks, in this video, we've sincerely got to talk about a concern of mine that could really start blowing up in 2022 and could be a long-term concern for us investing going forward. That what we're feeling in the market right now might be temporary euphoria again, but there could be larger issues at play, and that's what we're going to talk about starting right after I mentioned that, hey, in 2 days, the coupon code for the amazing programs of Building Your Wealth expires. You get lifetime access to the content, daily market live streams with me. You can ask me about your thesis. We can go back and forth on it. We've got an amazing group of folks, and I really think you'll love the fact that you pay once, and there's no upsell, you get lifetime access. The price does go up over time though, so you're better off joining earlier. Check out that coupon code linked down below. Okay, let's get into this. So here's the thing. We've got to talk about inflation only just to get it out of the way because there's a more important issue at play that we have to talk about. Inflation is very much expected to go down in 2022. I highly expect it to go down. The Fed believes it'll go down to 2.5%, but I expect about 50 to 60% of you watching this video don't believe a word the Federal Reserve says, so that's okay. The market itself might be a better estimate for you. The market believes that inflation is going to go down by the end of 2022 to 2.6 to 3%. So we've got this alignment. Myself, the market, the Federal Reserve, not that I'm trying to align myself with being an equal status as to one of those, but we together, there's this agreement that inflation should go down substantially in 2022, which is good, right? Yes, but there's a bigger warning. See, we're going to finish this thought on inflation, and we're going to talk about this bigger problem. We do know that the one thing that is actually expected to keep inflation higher is something that we know is higher than it's actually being measured by the CPI right now. You do have a lot of people who call the CPI a scam for this, but it's so well known that economists actually already anticipate that housing, for example, and wages are going to be lagging indicators. So see, when they calculate the CPI, they use this weird thing called owner's equivalent rents, but owner's equivalent rents aren't necessarily what market rents are. But on top of that, because it's difficult to just go around and survey all the properties that are on the market because we don't know if they're renting right away or whatever, usually what happens is people's expectations of their rents going up goes up slowly over time because it takes time for people's leases to expire, other properties to get rented, and then the market to go, oh wow, okay, that's the market value for rents now, and then rents slowly start going up. Even though you might not be able to rent a property today at what the CPI thinks inflation is today. It's purposefully designed as a lagging indicator, and it's important to know that. So like when I look at the CPI, I don't just go FUD, scam, fraud. I don't think it's perfect by any means, but I look at it and go, okay, I understand that's going to be a lagging wind, so to speak, that is going to keep inflation a little bit higher. Along with wages, CPI is not really good at tracking wage price growth. So both of these things together are going to create this wind that is going to keep inflation propped up, or maybe this foundation where we're not going to fall below or potentially to the Federal Reserve's inflation targets in 2022 or potentially even 2023. So these are concerns. And the only reason this matters is because if inflation doesn't go down quickly enough, we think the Federal Reserve might potentially be overly aggressive in raising rates. And this is what's going to create a really interesting dynamic in the market. See, one of the reasons that inflation is continuing to go up the way it is, because everybody just says yes. They say, just do it. In other words, whatever the price is, I'll pay it. And I'm not talking about wealthy people either. I'm talking about normal Americans every single day are just paying the higher prices. Nike is cheering the fact that they are having to mark down product less. They are cheering the fact that they're selling more of their products at full frickin' pop. People ain't even waiting for the coupon. And Chipotle is bragging about how their input costs did not go up. Like their meat and their rice. Even though we've seen a lot of meat inflation in the grocery store, Chipotle is bragging about how their meat and their, wheat prices, their meat and wheat prices haven't been going up. But their prices have been going up on what they're selling their product for because they can. This is really important because really what it means is prices and this inflation keep going up. And I'm not to try to confuse this and say that all inflation is caused by this, right? This would just be more consumer price focused. I know we've got lots of inflation in materials and other aspects as well. Certainly trucking and services, but that's more like producer price inflation. Here I'm more talking about consumer price inflation. So prices are going up because people are saying yes. And so what I think about this is at some point, and 2022 could be the beginning of this year, people are going to look and realize, oh crap, I don't have the cash flow that I had in 2020 or 2021. Part of that is going to be because about 80% of the children in our country receive the child tax credit. Well, their parents do, and those are huge stimulus checks. I mean, that's a fat stimulus check for every child that you have, on top of all the other forms of stimulus that we've gotten, like student loan forbearance. A lot of millennials have student loans. A lot of younger families with children, student loans. The unemployment, you still get unemployment. And there's still a lot of people on unemployment taking the child tax credit and student loan forbearance. There are a lot of people who took home forbearance, which I actually encouraged. Not initially, I was skeptical at first, but then I encouraged. And you can now, or you potentially already have, refinanced your mortgage forbearance from a 30-year fixed into a 40-year fixed, which just lowers your monthly payment and extends how long you're going to pay for them. So all of these things together in 2021 have really empowered consumers. And this isn't even like, when we think about stimulus, we're like, come on, there hasn't been a stimulus check in a long time. It's not true. Like people are, this tax filing season in April, between February and April, people are still gonna get half of their child tax credit for 2021 in a lump sum check. So some families are gonna be getting $5,000 to $10,000 depending on how many children they have, right? So the stimulus is still getting pumped, but that is coming to an end. This mortgage extension that Joe Biden just did, pushing out, student loan forbearance extension through May, that is going to come to an end. All these things are going to come to an end. And in my opinion, people are going to stop saying yes. At some point, people are going to stop saying yes. This is going to cause a few things to happen in the economy. But first, a quick message from our sponsor. I'm really excited to tell you about today's sponsor, Moomoo. Moomoo is an app that helps you trade like a pro. It does this by offering powerful analytic tools, commission-free trades, and reliable order execution. Moomoo's technical analysis tools are really easy to use and super helpful, especially to retail investors like you and me. Many sites charge for the information that Moomoo offers totally for free. They offer things like daily short-selling volume, financial statements conveniently available in the app, cost distribution data, and a community that talks about everything about finances and stocks. Right now, Moomoo's community is comprised of over 17 million traders. And since Moomoo offers commission-free trades, there really isn't a reason not to use them. The best part is, if you click the link in the description down below, you will get a chance to earn up to 5 free stocks worth anywhere between $3 to $3,500 when you open your account and deposit money. Terms and conditions apply. Thanks Moomoo for sponsoring this video. Check out that link down below and get your up to 5 free stocks. This is going to cause a few things to happen in the economy. First of all, businesses are going to get nervous. When sales numbers start going down and companies eventually have to start providing lower forecasts. I think we're going to have good forecasts for Q4 here. I think Q4 is going to be good. It's going to be spread out spending. We're not going to have that huge spike that we saw on Black Friday, but people still feel pretty lofty. I think Q1 probably going to be pretty great for consumers. People are going to have spent. We're going to see nice beats at companies. I'm optimistic about the next 2 quarters, but this video is really more broadly about 2022 in total. I think come Q2, 3 of 2022, we're going to see some frustration with consumers that I just don't have as much money as I did. I'm not as flush with cash as I was, and I got to spend less. And so we're going to rotate to a direction of frugality. It took a lot longer than I expected, but I think we are going to go into a direction of frugality. Companies are embarrassed, generally, to report that there's an inflection point in their sales. Because when there's an inflection point in their sales, the market doesn't look at the company like Nike. And let's say Nike sales started rotating down. The market doesn't look at Nike and goes, don't worry, it's not your fault. It's the consumers being frugal. They look and go, dude, do we need a new CEO? You know what I mean? Like, companies are going to look at this and they're going to get embarrassed. This, in my opinion, is going to force more creative brand advertising and just more advertising in general. Maybe not immediately. I don't think it's like, oh, January 1, everybody's advertising more. Probably Q2, Q3. At the same time, I do think there are going to be a lot of individual consumers who are like, crap, I really got to stop spending, but I want to because I want to keep up with the Joneses. You know, this is just more of a bias. I like the feeling of spending. What can I do to spend more? I could go into debt more. Oh, but wait, if I'm already maxed out on my credit cards, what do? Buy now, pay later. So I think buy now, pay later is going to be a big profitability sector going forward. But we've got regulators. You know, oh no, if regulators are looking at buy now, pay later, are they going to say no? Stay tuned. I'm going to give you my expectation of what regulators are going to do and how we're actually going to potentially sow the seeds of the next bubble, not just in stocks, but also in real estate. And I think crypto will just be along for the ride, unless, of course, there's a separate crypto issue, maybe related to stablecoins or some other stupid FUD, whatever. But I want you to be aware of how we can actually sow the seeds of the next bubble. That is, right now, I don't believe we're in a bubble. I do believe that valuations are elevated, but I sit behind a computer screen or a newspaper for 10 hours a day, every single day, plus all of the other work that I do. And so, yeah, it's possible I could be wrong, but at least from what I'm seeing right now, reading everything and just condensing everything in this one little sentence here, I don't think we're in a bubble right now, but I think we could be sowing the seeds of a bubble, and I'll show you exactly how that'll work. So here's what happens. Inflation takes longer to go down. Maybe rates then move up either as expected or slightly faster than expected. We see interest rates of 1 to 1.5%, 2%. That's not going to be that big of a deal for mortgages because I think what's going to happen is we're going to see the 10 and 15-year fixed rate mortgages stay somewhat stable and maybe slowly move up, but I don't think they're going to one-for-one move up with the federal funds rate. That's because, A, they don't. They align more with treasury yields than the Fed's funds rate. There's a separate market for mortgage rates, right? Mortgage-backed securities and so on. And two, what really can happen when the Fed funds rates goes up, the Fed funds rate goes up, is you just have a compression in the amount of money that banks can make. The spread goes down. Banks get more competitive for lending, right? So you don't necessarily have to see mortgage rates go up substantially, but you will see spreads tighten and mortgage rates go up somewhat. Okay, so what happens when mortgage rates go up somewhat? People have less cash, and maybe they're maxing out their credit cards and like, oh crap, okay, well, this sucks. You can't buy as much anymore. Well, the first thing that naturally happens is consumer activity goes down. And then the next thing that happens, well, or potentially at the same time, is people refinance less, which doing refinances is really interesting. See, in 2020, cash out refinancing activity fell to its lowest levels. It was like 30% of refinances were cash out. What that means is somebody goes and says to their bank, hey, I have a, $500,000 house. I only owe $200,000 on it. Can I take out $200,000 of cash to do whatever the hell I want with it? And then just leave $100,000 of equity. And the banks are usually like, yeah, let's go. So in 2020, we only saw 30% of refinances take cash out. Now we're seeing like 70% of people take cash out. So I think we've already started to see this transition where people are expanding their use of debt already to do whatever they can to keep that spending going. But there's a problem. And the problem is once you get to max credit card levels, you've used your buy now, pay later, and I can't refinance anymore because either I can't qualify or home prices aren't going up anymore because we've got a little bit of a headwind that interest rates went up a little bit. Again, not as much as the Fed, but now all of a sudden that puts a little bit of a lid or a headwind against real estate prices. So what happens? it doesn't make sense for people to refinance anymore because there's nothing to tap anymore. Like, you've already used the money and spent it. And this is one of the sad things people do is they'll refinance their house and then they'll be like, oh, I have $200,000. All right, I'm buying a new car. I'm buying a boat. People go spending like crazy. So anyway, this is where, at the same time as businesses potentially start noticing an inflection point in consumer spending, we could also see the government, regulators, and lending companies together. It generally takes everyone together, all of them. We could start seeing a loosening of credit standards. And this is where the bubble really begins. See, the government doesn't want to see lower spending going into an election because it looks bad. Banks want to be able to lend more money, but if they can't because the banking requirements are too tight and nobody's getting refinances anymore, and they complain to regulators that, hey, our lending system is too tight, we got to loosen, otherwise we can't stay in business. Then all of a sudden regulators, banks, and lending companies get together and say, you know what? Let's let people have more debt on their credit cards. Let's actually legalize buy now, pay later, and just require some disclosures, but let them use buy now, pay later. And I mean, not that it's illegal now, but look, there are regulatory questions around it right now. What I mean is, like, let's rubber stamp buy now, pay later, right? Yep, no, you're good. So loosening of credit standards, loosening of auto loan standards, loosening of buy now, pay later standards, and then, folks, loosening of mortgage standards. That is when we really create the bubble. Because now what happens is the people who are much less qualified to take on more debt from real estate, credit cards, buy now, pay later, and auto loans, just because, so that way they can spend more money on stuff to give a little bit of an extra boost. And you know what we create at that point? That's where we create a bubble. Look at lending standards. So take a look at this. First, it's worth noting that right now we're not there, in my opinion. One of the reasons we're not there is because, look at this, household debt service payments. So what you're paying in interest as a percentage of disposable income, we're pretty dang low. We are well lower than anywhere we were between 2012, honestly, anywhere we have been in really like the last 30 years, which is insane, 30 to 40 years here. We're at the lowest levels ever. So watch this potentially go up, but this, in my opinion, only goes up as we start seeing a reduction in lending standards. This here is the number of banks tightening credit standards. And so when you have a negative number, it implies loosening or not tightening. And we've already started to see a substantial loosening of credit standards. And that's because when you go into a recession, the first thing banks like to do is freeze credit lines and freeze loan lending, right? So credit standards go way up. But that's starting to plummet already. Auto loans are already starting to see a little bit of a plummet, but this could be nominal, and we could continue to see both auto loan standards, credit card standards plummet even more. So we want to pay attention to this being a negative here. So household debt, not substantially high right now, manageable. I mean, according to history, very, very manageable where we are right now. This is despite the fact that margin is at record highs. Then we have business and corporate debt at elevated levels, but we're at the lowest levels of defaults that we've seen in a very, very long time. I mean, certainly since before the pandemic, we're at the lowest levels that we've been seeing. So we're good right now, tentatively, on debt. But once we start seeing this inflation linger a little longer, federal funds rates getting pushed up, compressing the amount of liquidity we have in the markets because companies are investing less potentially because rates are a little higher. They've done their investing already, or consumers are starting to run out of cash. The next natural phase of a bubble is a loosening of standards. When you get a loosening of standards, what you're really doing is you're creating an Evergrand. I kid you not, and it can go fast. In August of 2020, I should say before August of 2020, the Chinese government for years said, please, real estate companies, take on as much debt as you can. We need to build lots of housing. We need to build these ghost cities to be prepared for this big population boom. Please take out more than 100% debt. I don't care what you got to do. Take out lots of debt. Just build. And that's what companies did. And what then happens is, as you create a real debt bubble, and now all of a sudden asset valuations really bubble up, the dangerous inflection point is when institutions and governments start noticing defaults Or you start noticing banks noticing the defaults, and then they start tightening credit standards again. You start seeing that tightening level go up a little bit, and it doesn't take much, but even just a little bit of an inflection point is a sign that, we're potentially heading into the ouchie period. Look at this. You saw the more tightening of credit standards in 2018, 2019, leading into the pandemic. You certainly saw credit standards increase at the end of 2017. They're always too late, by the way. Right before the dot-com bubble, we kind of saw credit standards start going up a little bit. They're usually too late with how they react. But once the tap turns off, like it does with Evergrand, now you have people potentially oversaturated with debt, and that is when you see a real bubble collapse. In my opinion, bubbles collapse or pop, sticking with the theme of a bubble, when people are way over leveraged and the tap stops. That's when we have a really big bubble. That's when we have a real estate crash. That is when we have a real stock market crash. And that's potentially where we end up trading sideways for a very, very long time. Now, this, I don't want to fear monger this, but I want to make everybody aware of this because it's something, in my opinion, every investor should be aware of. Because everybody's always, buy the dip and buy and hodl or whatever. Look at the S&P 500, okay? You zoom out on the S&P 500, we are at, obviously, essentially all-time highs here. Plus or minus a few days, whatever, right? But we're basically at all-time highs. Beyond that, we take a look at this right here. If you invested over here, anywhere around the middle of 1999 to the middle of 2001, before the dot-com bubble popped, if you invested at any point here, let's say you invested, what is this? This is March of 1999, okay? You invested during this time, you would have been negative until about 2006. And you would have, that's basically break even. So you would have been, your stocks would have done nothing basically for 7 years, okay? And then if you held on while it was slightly green, it was finally boom time, then you hit the 2008 recession, and it took you a total of about 13 years to basically break even on your stocks. That's insane. Like, your options could bankrupt you if you were just like heavy in options through this. Worth noting that of my portfolio here, I'll just show you really quick. So of my portfolio, I've got, here we go. We've got 900, almost $1 million in crypto. We've got stocks, we're sitting at about 30. Options, we're sitting at, this is in the course member section, by the way. Any course member can just look at the whole spreadsheet. Options at about 775. So my exposure to options and crypto I want to bump up a little bit. I'm probably going to get that closer to 10% as I find opportunities. But options, I'm definitely keeping a little bit low. And I'm trying to go long on shares, but I also got to get out of margin. I'm about 3 mil in margin right now, so I got to work on that. I want to get that down again, hoping that we do have a nice rally going into Q1 of 2022. But yeah, folks, look. Even if you invested over here in like 2007 and you just pulled this out, I mean, you were upside down for 6 years potentially. So stocks don't only always go up. And when we're at the tip of the curve here, at the same time as we're trying to understand what is going to happen with inflation and the Fed and all this stuff, I think it's very useful to look at all of our markets very broadly and say, we've got to be careful about the one thing, in my opinion, that can just destroy everything, and that is rates and the debt bubble. Mostly the debt bubble. If we get an inflection in the debt bubble, first we're going to get this massive loosening and potential bubbling, and then an explosion, and this potential loosening happens slowly. It creeps up on you, and that's where you want to be careful, right? Like, it's easy to say, oh, well, we've got to go through the bubble first, and then it'll pop, and I'll just get out while we're in the bubble phase. It can sneak up on you. Like, the slow inflating of the bubble can happen very, very slowly, and it can sneak up on you where all of a sudden just goes poof, and then you end up with 6 to 13 years of nothingness, right? Of the void. But a lot of this, in my opinion, is spawned by a debt bubble. If we have a debt bubble, then we end up with a Ray Dalio-style Great Reset. I don't believe we're at a debt bubble now. Looking at real estate debt, we are at the highest credit scores. Average credit scores like 760. Highest credit scores are getting loans. The lowest debt to incomes are getting loans. It's very difficult to get a real estate mortgage right now. The standards are tight. I think it's certainly become easier to get credit card debt. It's become easier to get into auto loan debt. But I think those standards could continue to worsen, and buy now, pay later could actually accelerate the cycle, which will be boom time for buy now, pay later companies. But you don't want to be in the buy now, pay later companies when the bubble pops, because they're going to be holding the bag of all the debt. So anyway, these are my thoughts. I am optimistic for the first half of 2022. I don't see a lot of negative catalysts, although I could be blind, so I'm always aware that I don't know, and when I don't know, I continue to hunt and I'll continue to look. But this is a very important message, I believe, that everybody should internalize and take advantage of, just like you should also take advantage of that coupon code link down below. All right, folks, thank you so much. The price does go up. I mean, look, sure, there'll be another coupon code in the future, but the price will be higher. So when you apply the coupon code now versus then, your then price will be higher. It's always going to be higher. Keep that in mind. Okay, thank you so much for being here, folks. I'll see you in the next one. Goodbye.